What's up, founders? Welcome back to 24/8. Here's something that might shock you. Founders obsess over valuation, but investors obsess over outcomes. And here's the kicker. That valuation number you're chasing? It's actually a promise you have to keep in real numbers. I've seen founders celebrate sky-high valuations only to realize they've trapped themselves in expectations they can never meet. So today, I'm going to show you what actually drives valuation, how to think about it strategically, and most importantly, how to avoid the traps that kill companies. What actually drives your valuation? The number you get isn't magic. It's a function of three things, and they matter in this exact order: proof, potential, and process. Proof, your track record. This is your growth trajectory, your retention numbers, your unit economics, and the quality of your sales pipeline. Proof is what you've already accomplished. It's the foundation everything else builds on. Potential, your market opportunity. This is about market structure. Are you in a winner-takes-most market or something more fragmented? What's your why now story? How does your competitive moat compound over time? Process, how you run the fundraise. This is about parallel meetings, credible lead interest, timeline discipline, and how well you handle investor objections. A great process can add 20 to 30% to your valuation. A bad process can kill it entirely. Let me give you a cautionary tale. Fab.com. They raised at absolutely eye-popping valuations with terrible retention numbers. High price with weak proof is a trap. When the story eventually broke, down rounds reset everything: company morale, governance structure, and their ability to recruit talent. Don't be Fab.com. Seed stage, caps versus reality. At seed stage, valuation usually shows up as a safe cap, sometimes with a discount. Here's what most founders get wrong. They think the cap is what matters. Wrong. Caps are optics. Ownership is reality. You need to model how your cap translates into actual dilution when you hit your Series A. And if you're stacking multiple safes with different caps and terms, good luck explaining that mess to Series A investors. I've seen A rounds completely stall because nobody could figure out what anyone actually owned after converting a zoo of different safes instruments. Here's a clean target. Raise enough for 12 to 18 months of runway while keeping your total dilution in a healthy range. By the end of Series A, founders should still own around 35 to 55% of the company, with founders plus the employee option pool controlling around 50%. This keeps incentives aligned and leaves room for future rounds. Series A, from story to hard math. By Series A, investors stop caring about your story and start triangulating between hard metrics. For SaaS and fintech companies, they're looking at revenue multiples. For consumer companies, it's growth rates and retention cohorts. For marketplaces, it's GMV times take rate. For almost everyone, gross margin and customer acquisition payback period matter. Your burn multiple, that's net burn divided by net new ARR, becomes a critical sanity check. Your cohort analysis tells them the quality of your revenue. Your backlog and pipeline show them your near-term growth engine. The levers you actually control. Here's what you can influence. Your trajectory narrative. Show the next 12 to 18 months as a series of dated, believable milestones. Not wishes, commitments you can actually hit. Your process design. Batch your outreach, compress your timelines, and keep multiple firms at similar stages of evaluation. Remember, momentum is everything. Your comparable framing. Use peer businesses with similar margin structures and growth profiles. Don't cherry-pick unicorns that operate with completely different business physics. Option pool math. Negotiate whether the option pool gets created pre-money or post-money. This is actually valuation math in disguise, so keep your eyes open. Trading terms for value. Sometimes the best move is taking a slightly lower price for the right lead investor, cleaner terms, and better follow-on investment capacity. Let me tell you about WeWork, the extreme example of headline valuation that completely outran governance and unit economics. Don't copy outliers on price. Copy their process discipline and metric honesty instead. Global and stage considerations. If you're raising outside the US, Series A rounds often price more conservatively and due diligence runs deeper. Lead with your cohort data and unit economics. Be explicit about your local why now, regulatory shifts, channel access advantages, or cost curve benefits. If you're raising cross-border, bring customer proof from each region you claim to understand. Scenario planning your round. Do this simple exercise. Create a table showing raise size, pre- and post-money valuation, option pool percentage and timing, founder dilution now and projected through Series B, and runway months at current and planned burn rates. Show the fund to milestone math so your valuation feels earned, not wished for. The traps that kill valuations. Here's what destroys credibility and, ironically, your final price. Chasing the absolute highest valuation while accepting terrible terms. Treating the safe cap like a victory while stacking confusing instruments. Hiding weak retention behind misleading averages. Pitching total addressable market top-down without any bottom-up proof. All of these moves actually reduce your credibility and hurt your final number. The psychology of valuation. Here's something most founders don't understand. Valuation is as much about investor psychology as it is about math. When multiple investors want in, prices go up. When there's no competition, prices go down. That's why your fundraising process matters so much. Create the right dynamics, and investors start competing with each other instead of negotiating against you. What great valuations actually look like. A great valuation isn't the highest number you can get. It's the right number for your stage, backed by solid metrics, from an investor you want to work with, on terms that don't handcuff your future. The best founders I know focus on building businesses that naturally command high valuations, rather than trying to manufacture high valuations around weak businesses. Here's the truth about valuation. It's not a trophy you win. It's a commitment to what you'll make true with that capital. Anchor your valuation in what you've already proved, what you'll realistically unlock with the funding, and the disciplined process that gets you there. The right number is the one that funds your path to inevitability while leaving you room to actually build the company. Everything else is just vanity. Remember, investors don't get rich from high valuations at seed or Series A. They get rich from exits. Build something worth exiting, and the valuation takes care of itself. That wraps episode 6 of 24/8. If this changed how you think about valuation, smash that like button. Subscribe for more founder-focused content that cuts through the noise and tells you what you actually need to know. Drop a comment and let me know. What's your biggest valuation question? I read every single comment and use them to shape future episodes. Until next time, focus on building something worth valuing, not just valuing what you've built. Keep building, keep proving, and keep winning.